As we take a look at what's happening on your televisions or on your phones today, you're probably seeing the stock market and the wild swinging up and down again. Markets are trying to assess the potential damage from President Trump's global trade war. There's a lot to try to parse out here. So joining me now is Ashley Schulman, partner and chief investment officer for Running Point Capital. Thank you so much for joining us.
Thank you. Thank you very much.
So let's keep this super simple for folks and talk about, let's start with today, if we could. What are you seeing today? Like, I know you're on California time, we're in Minnesota, 12:26 Central Standard Time. What are things looking like?
Yeah, it's still mid-morning here, and things are looking like people in the market are trying to figure out what's next. What's the resolution of the tariffs? The market has been wildly volatile. It opened down, it rallied up to positive. Now it's slightly negative. NASDAQ, which is your growth stocks, are flat. S&P's down about 1.7% at the moment. The relatively solid Dow Jones is down to 1%. People are just trying to figure out what's going on.
Go ahead.
Yeah.
I think go ahead.
No, go ahead, please.
Thank you. Sorry, a slight delay there. Is there something you can compare this to as somebody who lives and breathes this industry? I mean, what is this like?
So this is like the downtrend we saw in 2022 when there was a lot of market uncertainty and a lot of people thought there'd be a recession. We didn't have a recession. The difference with 2022, which was a bad year for stocks, is that the correction's happening much faster, whereas it happened over a few quarters in 2022. I think what most people need to realize, and it's a hard thing to conceptualize, is that not the entire market is selling off. Trading happens at the margins between buyers and sellers. And if there's a bunch of people trying to sell and not enough people stepping in to buy, the prices of the stocks drop. But it doesn't mean everyone's selling. Your pension funds, your endowments, your mutual funds, your ETFs are still holding huge amounts of stocks. And they're not selling everything. And that's, like I said, a hard thing to conceptualize, but people need to realize, it just takes a few people or a small number of people on the side looking to sell. And if no one's stepping in to buy, prices just drop. And so eventually they'll find a buyer.
Okay. And so Michael, so can we break this down by the type of consumer, the type of person who's looking at this? So if I'm looking at, say, retirement in the next 3 to 5 years, what's your advice if you're willing to do that, or what's your insight into what that person might be looking at right now?
So great question. People near retirement, they've got less time to recover from a market dip. There's an old saying, it's not about timing the market, it's time in the market. So over time, stocks tend to go up. So if you're in there long enough, you should be able to recover. But if you're near retirement, you need to start drawing funds from your retirement accounts, your 401k, your IRAs. During a downturn, you may be forced to sell at a lower valuation. Especially if you're not properly allocated and maybe have too much equity exposure and not enough bond exposure. Your bonds, your treasuries are doing relatively well. So if you have government bonds you can sell, they've actually gone up year to date.
One of the fears, I think, anecdotally, that you've probably heard this too, is, let's say if I'm looking at retirement in the next 5 years, am I looking at now working for another 10 years to try to, navigate all of this and this uncertainty?
No, I think 5 years to me is still kind of a mid to long term horizon. And so I think 5 years is more than enough time to recover. If you are already in retirement and you have required minimum withdrawals or you have to pull money, then, like I said, hopefully you've got a balance of stocks and bonds and you've got a proper roadmap and allocation. But if you're 5 years out from retirement, I'd say, stick with your plan and your allocation, maybe take advantage of the price dip in stocks and buy a little bit more. It's funny, when Neiman Marcus has a 35% off sale, people run to Neiman Marcus. But when stocks have a 35% off sale, people run away from stocks. And that's kind of the time when they really should be buying.
Yeah, and that's my next question, I guess, is for those who either dabble in the market or, are younger and are wondering kind of what their next moves should, as we look at sort of people talking about what first it was Black Monday, now they're calling it Red Monday. As we're looking at that, I mean, should something like that happen, are people kind of on the edge of their seats waiting for that to happen so they can buy in low?
A lot of people are, yes. But now's probably not a horrible time to start dipping in, especially if you're willing to dollar cost average. What does that mean? If you have $1,000, maybe you invest $200 a month for the next 5 months out of that 1,000 into the market. And because it's very hard to time and pick the exact bottom. But, I believe the Trump administration has a plan, and they're not going to wreck the US economy, and things will recover. And at this time, unless you really need the cash and liquidity, it might not be the best time to sell.
Okay. And then how about, can we talk about, because I read this stat, and you just let me know if this lines up with what you know to be true, but 10% of Americans own 88% of the stocks. The next 40% own 12%. So, we're talking about, assuming these numbers are correct, about half the country. But what about the ripple effect? We're talking about people who can play in this game, who can afford to play in this game. What about the ripple effect to those who can't afford to, or who are not in the stock market per se? What's the potential ripple effect there?
Yeah, so yes, to your point, the recent data indicates that approximately 10% of Americans own approximately 90% of stocks, but on a broader swath, about 58% of all US households have exposure to stocks, either directly or indirectly through mutual funds, ETFs, or retirement accounts. And that's up from 53% about 5 years ago. Ownership is less amongst Gen Z and Gen Alpha, but this group still has indirect exposure because many of them will inherit wealth and stocks from their silent generation grandparents and baby boomer parents. So, even though 58% have direct exposure, most of America has some exposure either directly or indirectly. And if you're Gen Z and Gen Alpha and just beginning to build your savings and maybe a stock portfolio or retirement portfolio, now's not a bad time to start doing that if you're thinking for the long term.
And then what about, you talked a little bit about this as you're comparing 2022 to now. And if I'm hearing you correctly, you're saying that the market's correcting a little bit faster this time around. So it sounds to me like, and you let me know, you're feeling like we are not heading into a recession. So let me just clarify that. Are those your thoughts?
Yeah, I mean, as you mentioned earlier, there's fears of a Red Monday or a Black Monday. And commentators are warning about a dramatic crash, citing the elevated valuations, geopolitical tensions. And these calls usually intensify after the sharp rallies like we've seen. But those kind of crashes are rare. And we've already taken, I think, the brunt of it last Thursday and Friday. I don't quite see a recession coming. It may happen because yield curve's inverted, where the 3-month T-bill is higher than the 10-year Treasury, which tends to be a leading indicator. But the market's staying afloat because if you think about it, we entered the year with a very strong economy. Unemployment was low. Economic growth, what people call GDP, but really that's just economic growth, has remained resilient. Consumers tend to keep consuming and using services. Oil prices have dropped, which should help alleviate some inflation pressure. There is global softness, but so far there's no imminent collapse in the economy. I'm not saying it can't happen, but so I don't see it yet.
Okay. What should we do for the next, a couple of days this week? Should we just kind of put our hands over our eyes and just not try to get, pulled in? Because it's very stressful for a lot of people to see these headlines and to watch the ticker go. What are we looking for in these next few days?
It is stressful. Look, as a chief investment officer, I cannot put blinders on. I can't put my hands over my eyes, but I think a lot of people and consumers can. You're in a situation now where, look, we could have another 5 or 7% drop. I'm not ruling that out. But if there's a hint of good news, if, the Trump administration strikes good, reasonable tariff deals with other nations, you could see the market jump up 5%, 10%, 8% in a day. That's possible. So we are in a volatile, jumpy market that's willing to turn on good news or bad news. And with that kind of volatility, as long as you have enough liquidity and cash to meet your near-term expenses, I'd say to ride it out. And maybe, kind of close your eyes a little bit.
All right. Thank you so much, Michael Ashley Schulman, Running Point Capital. We appreciate your time today. Thank you.
Thank you very much. Pleasure to be on.
All right.